I read the articles discussing Michael Burry. He's the guy portrayed by Christian Bale in The Big Short. Reading his comments about passive investing being the next bubble. Um, I'm not going to go quite so far as he will, but what I will say is that passive investing can and could create lots of problems if and when there's another market downturn. And here's why. Um, what the market doesn't really do well with what we call crowded trades. When the crowd tends to the market likes them when the crowd is piling into them. The market doesn't really like it when the crowd comes out. Um, and so what we've seen is a lot of money moving either to passive investment strategies, just buy an S&P index fund. We've been told that over time, if you just put your money in an index fund and close your eyes and watch it go, you'll do okay, which for the most part you will, because more often than not, the markets rise over time as long as the economy is growing and as long as monetary conditions permit. The problem with those trades when they're crowded is what happens when it's time to get out? And as more and more money moves toward passive investing, whether that's index funds or ETFs such as spiders or cubes or any of the other various popular ETFs out there, um, investors see the liquidity in the ETF itself, or can move money in and out of their index fund over time. But what happens is, if let's say for example you sell spiders, the S&P 500 ETF. Well, presumably someone's buying. Well, certainly someone would be buying the shares on the other side. If they build up a position long enough, they would want to hedge by selling the underlying securities. And what happens is, though, you're seeing sort of a top heaviness in liquidity. Spiders and QQQs and similar are in many ways way more liquid than the shares that they're representing at this point. You're getting the tail wagging the dog. And so what happens is that may not be quite so evident in the top 10, 20, 30, 50 shares in the S&P 500, let's say, but there's not great liquidity in numbers 400 through 500, or even that number could be 300 through 500 or whatever. It's all what's liquid or what's not liquid can be sometimes a flexible and arbitrary term. So I don't want to put too fine of a point on it. But the problem is, if there's enough selling in spiders, that's still got to flow back to the underlying shares. Then there becomes a lack of liquidity in the underlying shares. That gets forced lower. That forces the S&P 500 lower. That brings out selling, and you can see where that feedback loop ends. That's where I think the comment about it being a bubble comes in. Again, I think bubble is a more specific term of crazy overvaluation in one particular stock or industry or sector of the market or country or something that way. I don't think this is a bubble. I don't think the S&P 500, people who are buying S&P 500 index funds are paying what I would call a bubble price for those. But what I do see, and where I do agree with him that there are major risks, are if the market turns and people who've been buying ETFs on the premise that, well, they provide instant liquidity, you can always trade in and out of them. They provide instant liquidity as long as someone is there to make a price on the other side. That buyer is only going to be willing to buy if he or she can find prices for the underlying shares that make sense. As markets get fragmented, spreads tend to widen, moves tend to get magnified, and so I do see that there's a risk there. Not enough to necessarily go running for the hills, but I do think that there are structural problems that can be uncovered if we do have sort of a major market downturn.